This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call. You're watching us live from the CNBC TV18 Motilal Oswal studio. We're here, all four of us actually, so it's a packed Friday this morning. Morning to all of you guys. It's the end of the week finally, right?
Yeah, let's hope that's a good end to the week.
I don't know about that, but lots of cues lined up for today.
Indeed, and it'll be interesting to see how we marry the weakness on the global front on equities versus the positive news that we've got on the bond market front.
Absolutely, and that's where we're going to kick it off, right? That's the big headline that we're dealing with this morning, and perhaps that the market may react to as well. The fact that India will be included in the JP Morgan Global Emerging Market Index from June 2024. Now, this is important because I'll tell you why, but India is expected to reach a maximum weight of 10% in the Global Diversified Index. And JP Morgan said that 23 Indian government bonds with a combined notional value of $30 billion are eligible. This is, of course, this could lead to a rally in the bond market, and there could be perhaps large inflows into banks and domestic cyclicals. That's what the street believes. So that's a big positive that they're working with. But the big question that we're asking is, there is this overhang of negative global cues. Could that continue to put pressure on our markets, which has been the case over the last many days? So definitely risk aversion is something that has continued. The US markets are down for the third straight day. The Dow, in fact, lost almost 400 points overnight. And, even the Nifty has been lower for the third straight day. Financials have been a big drag in the last many days for the market. And there was large selling. In fact, third straight day of selling by FIIs in large quantities. So yesterday as well, over 3,000 crores was taken out by FIIs. So, the big question is, of course, this bond inclusion news is positive. But I think the larger story is the risk aversion globally. The fact that perhaps rates are going to be higher for longer, so maybe equities could take a backseat for a while, is something that the street is pricing in.
Well, that's right. And, this week has been weak, Sonia. So if you look at it, the Nifty Bank as well, it's one of the worst weeks we have had in multiple months. So positioning going into this Friday is on the weak side. Could we see a relief rally for the Nifty today? Well, let's see, because the GIFT Nifty is suggesting that we pull back a good 80 to around 100 points odd. And why do I say that? As Sonia said, well, there's that positive news coming in for the emerging bond market with India getting included. So that's one factor. And how does it rub off? Yields will cool off a little bit. You'll have the rupee as well that will stabilize, and the money market stabilizing will be a good sign. Next up, the FI as well, they've added some short positioning. And the Nifty as well as the Nifty Bank, both of them are near very, very crucial supports. Let's take those points individually. Yesterday, the FI as well, they added short positions, close to around 15,000 short contracts, though they continue to remain net long with 56% of their positions on the long side. But just last Friday, the net long positions were more than 65,000 contracts. That's come down to around 22,000 contracts odd. So that chart should come up for you. The long positioning has come down, and I'll tell you what, I like shorts in the system because in case there is some good news, that could be the reason that the markets bounce from here. On the options side, you had the 19,800, 19,900 call. Both of them had a big amount of open interest build up, close to around 1 crore shares out there. But on the downside, there was activity at around 19,700. And since the 19,700 put, the premium was around 75 rupees. You deduct 75 rupees from around the 19,700 odd mark. The crucial support will be at around this 19,600, 19,625. And I say that because in this range of 19,600 to 19,700, you have the 20 as well as the 50 DMA. So those are the markers on the downside. The Nifty Bank, well, yesterday it broke the 20 as well as the 50 DMA. But all eyes on the 100 DMA. On a closing basis, we managed to defend that mark. That's going to be very, very important. The GIFT Nifty, it's suggesting a pullback. Let's see whether or not we can bounce back from here. There are ingredients actually in place that we could see a bit of a relief rally because positioning is such getting into this Friday. Rima, what else?
Well, a bad week has just gotten dismal, right? In terms of the global markets, the Indian markets have fallen for the third consecutive session. Week today, the Nifty is down more than 2%, 2.2%. The mid-cap index has plunged 1.6%. And if you look at the Nifty fall from our all-time high levels of 20,222 that we just hit last Friday, the Nifty is virtually down close to about 500 points. The GIFT Nifty today is suggesting a much lower start. currently down by close to about 100 points. At the opening level, the GIFT Nifty would be very, very close to the 20-day moving average on the Nifty, 19,662. So let's see, 686. So let's see whether that can hold out. Asia this morning is broadly lower. But the big, the development, the big headline is that India is going to get added to the JP Morgan Global Bond Index. Now, this is a big milestone. India was the only large emerging market which was not a part of any emerging market bond index. We've been on a watch list for a long time. We've been waiting for quite a while. And finally, Lata, this has happened. So take us through the implications for the news, the implications for bond currencies and even banks.
Okay, well, for starters, the numbers itself, the index into which India gets included is called the GBI EMGD, which is the Global Emerging Market Index, Global Diversified. That's what that GD means. Now, 330 billion of Indian bonds become eligible, but that doesn't mean all of them, of course, will be bought. The weight of the index, this GBI EMGD index, the total amount of bonds benchmarked to it is 236 billion. And currently, it accounts for 213 billion in terms of market cap. Now, India gets a 10% weight of this, which will start from June 28, 2024, with 1% getting added every month. That is so that it is non-disruptive. So, if we are going to get 10% of a current 213 or an eventual 236 billion getting benchmarked, it is an approximate 21 billion, if you take it conservatively, when the entire 10% comes in. So 1% a month will mean 2 billion become eligible. At the entire 10%, it'll be, somewhat 21 billion will be about 1.8 lakh crore. Now, every year, the Indian government issues fresh about 4 lakh crore of Indian bonds. So next year itself, it's going to be very good for the government that comes in, because you're going to see, a big buyer come in, and therefore the bond yields will fall. Now, what happens today itself? Chances are that today we are going to see an initial reaction which will be positive and bond yields will fall. But given that, the Indian market has not reacted to 4.5% US 10-year yield. So that's a huge counter negative that comes in. We will have to see, because yesterday, when the US bonds went from 4.23 to 4.33, we didn't budge. So a part of that is already in the price. So today at 4.5, will we still not budge? We will have to wait and see. I'll defer to the experts when they join us. But nevertheless, chances are that there will be some bit of bond gain for banking stocks, because this comes very close to September 30, very fortunately. So the mark-to-market gains are likely to be there. And so there, I would think, be some kind of a rally even in the bank stocks. But overall, this is a positive macro, because if the sovereign pays less for their loans, for her loans, all corporate bonds are benchmarked to it. The best AAA bonds will be about 20-30 basis points higher in yield compared to the sovereign. If the sovereign is paying about 7% for their borrowings, then you are going to have a lower cost for corporate India. Therefore, highly leveraged companies, probably metal companies and such like, Nigel, you'll be better placed, should also see some advantage. Now, I am at a loss as to how much of the gain will show in today's market, because the circumstances are so adverse. But in the long run, this is a concrete EPS positive, EPS accretive news starting June, of course.
So cost of capital, cost of borrowing goes down, and it also brings in the much needed depth in the bond markets, right? So we'll, of course, talk about that. Thanks a lot, Lata. We'll get many experts to join us in the next couple of minutes, so don't go anywhere.
There's a bit of currency rub-off as well.
Currency appreciation is what
there is less depreciation because of the strength of the US dollar. But I must say that today, there are 10 other factors weighted against all this.
There's this overhang of negative global cues. I take that point. And of course, the GIFT Nifty is indicating that the start will be in the red as well. But here's what you'll get to see in the first half hour of the show. We'll get you updates from the market across the globe. Gary Schlossberg of Wells Fargo Investment Institute will join in to discuss the global trade setup. We have a research team also joining in to bring you CNBC TV18's list of top 10 stocks for the day. At 8:30 a.m., we'll do a fundamental stock analysis with Dipan Mehta of Elixir Equities. All right, on the equity front, we have Jonathan Garner, one of the best voices in the business of Morgan Stanley, saying that post the FOMC, the US 10-year real yields have risen to a new high for the cycle of 2.05%. This further increases the conviction that Asia-Pacific ex-Japan EM investors should play defense and in particular rotate towards India on its strengthening fundamentals and low beta to US equities.
Let's get you some money market views then. Lakshmanan V, a Federal Bank, says the dollar index strengthened to a 6-month high as the Fed held the rate in its latest meeting, and the expectations are now for higher rates for longer. He says rupee showed some volatile movement during the week between bouts of strong dollar and selling. He adds a breakout on the rupee on account of bond inclusion will see trade in the range of 82.5 to 83.15 against the dollar going ahead.
Okay, it would be interesting to see the reaction today on the back of this news flow. On the bonds, Lakshmanan says domestic bonds will open significantly higher on the bond inclusion news. He says we can expect market moving towards 7% and then consolidation in the 7 to 7.1% zone, with a possible move below 7% not ruled out.
All right, let's get to the stocks that we'll be tracking in our special top 10 segment, which we'll get to that in broader detail in just a bit. For the time being, let's list out the stocks. We're looking at banks, Glenmark Pharma, Idea Forge Tech, RVNL, NBCC, and Suntech Realty. All of them will be reacting to positive news flow, while on the flip side, you have Glenmark Life Sciences, Wipro, ICICI Lombard, and ICICI Securities that will be reacting to negative news overnight.